What if a single internal document, never meant for public eyes, had the potential to expose the weakest link in the global precious metals market? Not a government announcement. Not a central bank speech. Not a viral tweet. But an alleged internal directive from one of the world's most powerful financial institutions. In early January 2026, reports began circulating in financial circles and alternative market research communities about an internal board-level instruction allegedly connected to HSBC Holdings, one of the largest bullion banks operating in the London precious metals market. The claim was explosive. Not because it predicted a price. Not because it promised profits. But because it questioned the structural integrity of the system that sets the global price of silver. This video is not here to confirm or deny the authenticity of any leaked document. We are not here to make accusations. And we are certainly not here to give financial advice. What we are here to do is something far more important. We are here to analyze why this claim matters. What it implies about the silver market if it were even partially accurate. And why silver, a metal most people stopped thinking about decades ago, is suddenly back in the center of a very serious conversation. Because regardless of whether any specific document proves to be real, the questions it raises are very real. And those questions point to something much larger than one bank. They point to a system under stress. To understand why this story has captured so much attention, we first need to clear up a common misunderstanding. Silver is often treated as a poor man's gold. A secondary metal. A speculative side trade. But in the modern global economy, silver plays a role that is both monetary and industrial, and that combination makes its market uniquely fragile. Silver is used in electronics, solar panels, electric vehicles, medical equipment, data centers, military hardware, and increasingly, in the infrastructure that supports artificial intelligence and advanced computing. Unlike gold, most silver is consumed. Once it's used, it often doesn't come back to the market. And unlike copper or aluminum, silver's supply chain is relatively small. That means the silver market doesn't need a massive disruption to feel pressure. Even a modest imbalance between supply and demand can have outsized effects. This is why silver has historically been one of the most volatile major commodities. And volatility, in financial markets, is rarely accidental. When people think of commodity trading, they often picture futures exchanges like COMEX in New York. But when it comes to physical silver pricing, the real center of gravity sits thousands of miles away, in London. The London bullion market is not a traditional exchange. It is an over-the-counter network where a small group of large financial institutions act as market makers. These institutions quote prices, facilitate trades, and, most importantly, provide liquidity. If you are a sovereign entity, a central bank, a multinational corporation, or a major industrial buyer, chances are your silver exposure is priced through London. Which means the stability of the silver market depends not on millions of participants, but on a handful of institutions functioning smoothly. That structure works beautifully. Until it doesn't. It's easy to dismiss stories involving leaked directives or internal memos as internet speculation. And to be clear, skepticism is healthy. But markets don't react to documents. They react to possibility, risk, and credibility. When claims emerge that involve named institutions' specific timelines, operational constraints, regulatory consequences, they trigger analysis, not belief. Professional investors don't ask, is this true? They ask, what if even 10% of this is true? Because markets price risk, not certainty. And the alleged directive attributed to HSBC touches on one of the most sensitive risk categories in finance, liquidity risk in a thin market. The silver market is large in dollar terms, but small in physical reality. Daily trading volumes can appear enormous, until you look closely and realize most of that volume is paper transactions, not physical metal changing hands. In normal conditions, this is not a problem. Paper markets exist precisely because physical settlement is slow, expensive, and unnecessary for most participants. But paper markets rely on trust. Trust that physical metal exists if it is ever demanded. Trust that counterparties can settle obligations. Trust that extreme scenarios won't occur. History shows us that when trust is questioned in thin markets, prices don't adjust gradually. They gap. Another reason this story gained traction is timing. We are entering 2026 with elevated geopolitical tensions, ongoing de-dollarization discussions, increasing scrutiny of banking balance sheets, Basel III capital rules, tightening sovereign interest in physical commodities. In other words, the environment is already stressed. When systems are stressed, they don't need massive shocks to crack. They only need pressure in the wrong place. Silver sits at a crossroads of monetary confidence, industrial necessity, financial leverage that makes it a natural fault line. Before we go any further, It's important to set expectations. This video will analyze how the silver market functions, explain why large banks matter disproportionately, break down the claims being discussed, carefully and conditionally. Explore hypothetical scenarios using historical precedents. This video will not confirm leaked documents, predict prices, tell you to buy or sell anything, promote fear or urgency. Our goal is understanding, not excitement. Because in finance, excitement is usually expensive. Some viewers may ask, if this is all alleged, why analyze it at all? The answer is simple. Financial crises rarely announce themselves clearly. Before 2008, there were rumors about mortgage risk. Before the nickel short squeeze in 2022, there were impossible scenarios. Before sovereign debt crises, there are always unlikely outcomes. Markets fail not because risks are unknown, but because they are dismissed. By analyzing extreme claims responsibly, we test the resilience of the system. And what we often discover is that systems are far less robust than they appear. The bigger question beneath the story: strip away the names. Strip away the dates. Strip away the numbers. At its core, this story asks a single question: what happens when paper promises collide with physical reality? That question is not new. It has appeared throughout financial history, in gold, oil, housing, currencies, and bonds. Silver may simply be the next arena where that tension becomes visible. We will explain how the London silver market actually works, what market makers do, and why they matter, why losing even one major participant could have outsized effects. Only after understanding the machinery can we responsibly evaluate the claims being discussed. Because without understanding the system, every story sounds either terrifying or ridiculous. And in finance, both extremes are dangerous. To understand why claims about a single bank exiting the silver market matter at all, we need to step back and examine the structure of the market itself. Because the silver market does not function the way most people imagine. There is no single exchange where all silver trades occur. There is no centralized order book showing every buyer and seller. And there is no warehouse door where metal constantly moves in and out to match every trade. Instead, the global silver market, especially the physical market, is built on a layered system of trust, relationships, and settlement conventions that developed over decades. At the center of that system sits London. The London bullion market is not a traditional exchange like the New York Stock Exchange. It is an over-the-counter market, often abbreviated as OTC. That means trades are negotiated directly between participants, not matched through a public exchange. Prices are quoted privately. Contracts are customized. And settlement often happens without metal ever moving. The organization that oversees standards and participation in this market is the London Bullion Market Association, or LBMA. The LBMA does not trade silver itself. It sets the rules, accreditation standards, and reporting frameworks that allow the market to function. Membership is restricted. Only a small group of large financial institutions, primarily global banks, are authorized to act as market makers. And that fact alone tells us something important. This market was never designed for transparency. It was designed for efficiency at scale. A market maker is an institution that continuously provides buy and sell prices. They don't wait for someone else to step in. They stand ready to take the other side of a trade. This creates liquidity. If you are a mining company hedging production, you need a buyer. If you are an industrial user locking in supply, you need a seller. If you are a sovereign entity adjusting reserves, you need both. Market makers absorb these flows. They manage risk using derivatives, leasing, internal inventories, and offsetting positions across markets. In calm conditions, this system works extremely well. But here's the critical detail. In the London silver market, there are very few market makers. Depending on the year, the number typically ranges between 5 and 10 institutions. That means the market's stability depends not on competition, but on cooperation. Each market maker assumes the others will remain active. Remove one, and the burden on the rest increases. Remove more than one, and the system begins to strain. To understand why silver markets can appear liquid while being physically tight, we need to discuss allocation. In the London market, most silver exposure is held in unallocated accounts. Unallocated silver is essentially a claim on a pool of metal. The holder does not own specific bars. They own a promise from the bank. This structure is efficient. It allows silver to be traded like a currency. But it also means multiple claims can exist against the same physical inventory. Allocated silver is different. Allocated silver means specific bars are assigned to a specific owner. Those bars cannot be used, leased, or pledged without the owner's consent. Allocated silver behaves like property. Unallocated silver behaves like a liability. And in normal times, most participants are comfortable with liabilities. Until they're not. A common misconception is that every silver trade implies physical delivery. In reality, physical delivery is the exception, not the rule. Most trades are settled in cash. Contracts are rolled forward. Positions are netted internally. This keeps costs low and turnover high. But this structure relies on an assumption that physical delivery requests will remain manageable. The system is not designed to handle a sudden, large-scale shift from paper claims to physical demand. And that's not a flaw unique to silver. It's a feature of modern financial markets. On paper, the silver market appears massive. Daily trading volumes can exceed hundreds of millions of ounces. But here's the key point. Trading volume does not equal available supply. Most volume represents derivatives changing hands, positions being rolled, internal netting between institutions. The amount of silver that is actually available, unencumbered, and ready to be delivered at any given time is much smaller. This is why analysts often describe silver as a thin market. Thin markets function smoothly until a large participant needs to move urgently. Despite futures exchanges in New York and Shanghai, London remains the primary hub for physical pricing. Why? Because London connects mines, refineries, vaults, banks, sovereign entities. The London price is the reference point used in contracts worldwide. Even futures markets ultimately reference London pricing mechanisms. This means disruptions in London don't stay in London. They ripple outward. Over-the-counter markets rely on trust more than transparency. Participants trust that counterparties are solvent, positions are properly hedged, inventories are sufficient, regulators will intervene if necessary. This trust allows enormous leverage to exist quietly. But when trust weakens, OTC markets can seize up very quickly. Participants stop quoting prices. Bid-ask spreads widen. Liquidity disappears. And once liquidity disappears, price becomes irrelevant. Because price only exists when trades occurs in highly centralized systems, large institutions carry disproportionate weight. A single major market maker exiting does not simply reduce liquidity by 20%. It can reduce it by much more. Because the remaining market makers must absorb additional flow, increase capital allocation, take on more risk at some point, they step back. Not because they want to, but because they have to. This is how markets don't crash. They stop functioning. We've seen this dynamic before. In energy markets. In currency pegs. In sovereign debt. When a large participant is forced to unwind positions in a thin market, the issue is not whether the market can absorb it. The issue is how much damage occurs in the process. Sometimes, regulators intervene. Sometimes, contracts are modified. Sometimes, markets close temporarily. None of those outcomes require conspiracy. They only require math. One of the most misunderstood ideas in financial markets is the concept of a short. To most people, shorting simply means betting on price going down. In institutional markets, it's far more complex. A short position is often the result of providing a service. Banks and large dealers frequently go short not because they are bearish, but because someone else wants exposure. A mining company wants to lock in future prices. An industrial user wants predictable costs. An investor wants price exposure without storage. The bank becomes the counterparty. In that role, the bank absorbs price risk and manages it across the system. Some of that risk is hedged with futures. Some with options. Some with physical inventory. Some with offsetting client flows. The net position is what matters. Over time, these flows accumulate. What starts as client facilitation can grow into massive gross exposure. Especially in markets where one institution dominates liquidity provision. A large short does not necessarily mean a directional bet. It often means the institution is standing between buyers and sellers. But standing in the middle carries responsibility. When everything is functioning normally, this role is profitable. Spreads are collected. Positions roll. Volatility is managed. But when the market changes character, the same role becomes dangerous. Covering a short is not symmetrical with opening one. Opening a short can be done quietly over time. Covering a large short requires buying. And buying creates impact. Impact is the real risk. When you buy into a thin market, your own demand moves the price against you. The larger you are, the worse it gets. This is why large institutions often cover shorts gradually. They use algorithms. They split orders. They operate across venues. But even then, scale matters. If the size of the short is large relative to available supply, there is no perfect exit. There is only damage control. Another misconception is that physical metal and paper contracts are interchangeable. They are not. In calm conditions, they behave similarly. In stress, they diverge sharply. A futures contract can be closed financially. A physical obligation cannot. If delivery is demanded, metal must exist, or terms must change. This is where timing becomes critical. If delivery windows align with rising demand, pressure concentrates. Even institutions with strong balance sheets face difficulty. This is also where reputation risk enters. Markets are built on trust. If counterparties question whether obligations can be met smoothly, behavior shifts quickly. The most dangerous moment for any large short is when counterparties start preferring delivery over settlement. That changes everything. Historically, when this happens, several patterns emerge. First, lease rates rise. This signals tightness in physical availability. Second, premiums appear between physical and paper prices. Third, delivery times extend. None of these are random. These signals don't always lead to crisis, but they do indicate stress. And stress changes decision-making. Banks are particularly sensitive to this because of regulatory exposure. Capital rules treat unhedged or uninsured positions harshly. What was once manageable becomes a compliance issue. Insurance plays a critical role here. Precious metals positions are often insured against loss, theft, or discrepancy. Without insurance, capital charges rise dramatically, sometimes to prohibitive levels. This means that a change in insurance status can force action, even if the market itself hasn't moved yet. This is why sudden position reductions sometimes appear out of nowhere. They are driven by internal constraints, not market signals. Another key factor is counterparty concentration. If a large portion of exposure is tied to a small number of clients, their actions matter disproportionately. If one major client changes behavior, the entire risk profile shifts. This is especially relevant when clients are sovereign entities or strategic actors. Their motivations differ from financial investors. They care about control, not just price. When such clients request delivery, negotiation becomes limited. Deadlines matter. At that point, the institution is no longer managing risk. It is managing outcomes. This is where hybrid strategies appear. Some exposure is closed financially. Some is rolled. Some is settled in cash. Some is sourced physically. It's messy. But it's how large exits actually happen. The cost of this process is rarely the headline number. It includes market impact, opportunity cost, legal expenses, reputational damage. These are difficult to quantify but very real. This is why institutions avoid being forced into exits. Voluntary exits can be optimized. Forced exits cannot. All of this context matters because it frames the claims being discussed. Not as fantasy. Not as certainty. But as a scenario that fits known market mechanics. Whether any specific detail is accurate is less important than whether the structure allows such stress to exist. And the structure does. Which brings us to the specific allegations that spark this discussion. Not to confirm them, but to understand what they imply, if true, within the framework we've just explored. At this stage, it's important to slow down and separate structure from speculation. What's circulating publicly is not a confirmed event. It is a claim. An alleged internal situation. And the only responsible way to approach it is analytically. The claim centers around a sudden need by a major institution to dramatically reduce silver exposure within a compressed time frame. Not over years. Not gradually. But quickly enough to overwhelm normal market processes. If such a situation were real, it would not begin with price movement. It would begin internally. With audits. With reconciliations. With risk committees asking uncomfortable questions. Large institutions constantly reconcile positions. They match. What is owed, what is held, what is insured, what is reported. Most of the time, discrepancies are small and resolved quietly. But when discrepancies are large, the response escalates. One of the most sensitive areas is allocated metal. Because allocated metal is supposed to be the simplest category. It either exists, or it doesn't. There is very little flexibility. If an internal review were to find a mismatch between reported allocated holdings and verified physical inventory, that would immediately trigger alarms. Not market alarms. Compliance alarms. The first response would not be public. It would be containment. Verification. Documentation. Engagement with auditors. At the same time, counterparties would be contacted. Not with panic, but with clarification requests. These are routine in appearance, but serious in implication. Another pressure point in such a scenario would be insurance. Precious metals insurance is not optional. It is a prerequisite for holding large positions under modern banking rules. Without it, capital requirements can spike dramatically. If insurers detect inconsistencies between reported exposure and physical reality, they reassess coverage. Sometimes coverage is adjusted. Sometimes premiums rise. In extreme cases, coverage is withdrawn. This matters because banks cannot simply self-insure massive physical positions. Insurance is embedded into the regulatory framework. Lose it, and the position becomes non-compliant. At that point, the institution faces a binary choice: reduce exposure or lose operational permissions. Another factor often overlooked is external verification bodies. Certain markets rely on centralized clearing and reporting organizations. These bodies periodically require proof of metal existence. Not summaries. Not estimates. Proof. If deadlines exist for such verification, they introduce time pressure. And time pressure changes strategy. The claims also involve large counterparties requesting physical delivery. Again, not unusual in isolation. But scale matters. When a delivery request is small, it's routine. When it's large, it becomes strategic. Sovereign or state-linked entities behave differently from private investors. They are less sensitive to short-term price. They care about certainty, security, and control. If such an entity were to request delivery within a fixed time frame, flexibility would be limited. Extensions might be possible, but not indefinitely. At this stage, an institution would begin scenario modeling. Not to predict price, but to evaluate damage. Best case outcomes. Median outcomes. Worst case outcomes. These models are not forecasts. They are stress simulations. They answer one question: how bad could this get? Market impact modeling would consider available physical supply, daily trading volumes, likely counterparty behavior, competitive demand. The goal is not precision. It is survival. One of the most sobering realizations in such models is that physical supply is finite. Paper positions can be closed. Physical obligations cannot be created on demand. This leads to hybrid strategies. Not because they are optimal, but because they are necessary. Some exposure is closed in futures markets. Some options are allowed to expire or are exercised. Some OTC contracts are renegotiated. Some physical delivery is attempted. Some obligations are settled financially. Each of these actions has consequences. Closing futures pushes prices. Negotiating OTC settlements risks signaling weakness. Sourcing physical metal reveals scarcity. And throughout all of this, the institution must manage optics. Because markets react not just to facts, but to perception. If counterparties sense urgency, they adjust behavior. They delay selling. They request stronger terms. They demand higher premiums.
And this is where numbers replace narrative, because markets don't respond to stories, they respond to capacity. When pressure builds in any commodity market, the first question institutions ask is simple: how much can the market absorb? Not emotionally, not theoretically, but mechanically. The global silver market, despite its importance, is relatively small. Annual mine production is finite. Recycling adds some supply. Above ground inventories exist, but they are not all available. Much of it is held long-term, locked in industrial use, strategically reserved. What's available at any moment is a fraction of what exists in total. Daily trading volume can look large on paper, but most of that volume is financial. Contracts changing hands, not metal moving. When modeling stress, institutions strip away the paper volume and focus on what actually matters: deliverable supply. If a large participant needs to source metal, they are competing with industrial demand, investment demand, strategic accumulation. These demands do not pause just because one buyer is urgent. This is where scale becomes decisive. Buying small amounts blends into the market. Buying large amounts reshapes it. At a certain size, the buyer becomes the market. And when that happens, price is no longer a signal. It's a consequence. Models account for this by running scenarios, not predictions. Scenarios. In a best-case scenario, sufficient metal appears, prices rise, but sellers emerge. The exit is expensive, but orderly. In a median scenario, availability tightens, prices rise sharply, liquidity deteriorates, cash settlements increase. In a worst-case scenario, physical supply becomes the constraint. No price clears the market smoothly. Negotiation replaces trading. The most important insight from such modeling is usually this: there is no scenario where large, urgent demand does not move price significantly. The only variable is how chaotic the process becomes. Another reality often overlooked is competition. Markets do not pause for one participant. If demand rises visibly, others respond. Some buy defensively, some hedge, some accelerate existing strategies. Strategic actors, especially, do not wait. They front-run scarcity, not for profit, for security. This introduces a dynamic where urgency feeds urgency. Even rational actors behave in ways that amplify pressure. This is why models frequently underestimate real-world impact. They assume static behavior. Markets are not static, they adapt. At this stage, institutions often realize something uncomfortable. The exit is not just expensive, it is transformative. It changes how the market functions. This is when secondary effects appear. Premiums between physical and paper widen, delivery times extend, lease rates rise, confidence becomes selective. None of this requires panic. It only requires preference shifts, and preference shifts happen quietly. Another factor institutions must consider is geopolitics, not as ideology, but as behavior. When states or state-aligned entities participate in markets, their objectives differ. They are not optimizing quarterly returns. They are optimizing resilience. When such actors sense stress in supply chains, they do not wait for confirmation. They act preemptively. This behavior can appear aggressive from the outside. From their perspective, it is defensive. The result is competition for the same finite resources, not between speculators, but between systems. This is how localized stress becomes global, not through headlines, through flows. Over time, these dynamics force adaptation. Contracts change, risk limits tighten, leverage reduces, markets become less abstract. This process is not dramatic, it is incremental, but it reshapes incentives. Historically, similar moments have occurred across markets, in energy, in bonds, in currencies. Each time, the lesson is the same. Liquidity is not infinite, and leverage is only safe when confidence is stable. When confidence shifts, systems reveal their true constraints. This does not mean collapse. It means repricing. It means restructuring. It means evolution. For observers, the temptation is to focus on price targets, specific numbers, specific dates. These are distractions. The real story is structural. It is about how modern markets reconcile abstraction with reality. Whether any specific claim proves accurate is almost secondary. What matters is that the system allows such stress to exist, and systems eventually respond to stress, sometimes quietly, sometimes visibly, but always inevitably. For long-term participants, the takeaway is not action, it is understanding. Understanding how exposure differs from ownership, how liquidity differs from availability, how price differs from certainty. Those distinctions matter most during transition periods, and we are living through one. Markets today are adjusting to a world with higher geopolitical friction, higher strategic competition, lower tolerance for abstraction. That adjustment is uneven, but it is ongoing. Silver, in this context, is not unique, it is illustrative. It shows how quickly assumptions can be tested, how rapidly incentives can shift, and how important structure is when stress appears. In the end, markets are not moral systems, they are mechanical ones. They respond to pressure, not intention. Those who understand the mechanics are rarely surprised. Those who don't often mistake outcomes for shocks. This moment, regardless of outcome, is a reminder that beneath every chart is a structure, and beneath every structure is a limit. When limits are approached, behavior changes, not because of fear, but because of reality, and reality always asserts itself eventually. That is the real story here, not what might happen next, but what this reveals about how the system works. Understanding that is more valuable than any prediction, because predictions expire, structure remains, and those who take the time to understand structure tend to navigate uncertainty far better than those who chase certainty. That's where this ends, not with a conclusion, but with clarity.